And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning. Welcome to the show. Of course, it is Thursday, second best day of the week, and your public service announcement for today. Don't forget that tomorrow is Valentine's Day. I'm trying to save these guys. I've been doing my best all week to remind people, you guys, that tomorrow's Valentine's Day. So don't say I didn't warn you, just in case. Don't let me know. My wife's filing divorce papers. I warned you. So there you go. Anyway, a couple of things to get into. Of course, Michael Lee was joining me this morning, so we'll get all into the inflation report yesterday. Of course, Jerome Powell was testifying on Capitol Hill as well yesterday, actually for the last 2 days, his annual congressional testimony. So we'll kind of get into some of those comments, talk about inflation yesterday. Did anything change? Is anything different? You know, we'll get into all of that. Just very interesting, you know, though, it's interesting to see the wide variety of headlines that are pushed out, of course, around, you know, these monthly events, which really have no bearing on pretty much of anything. You know, everything is volatile, and particularly when you're measuring things over year-over-year basis, you have, you know, year-over-year base effects where your number that you're comparing to last year is higher or lower than the one you're comparing to this year, and it creates these volatile bounces in the data. And there's certainly some short-term impacts that are impacting economic data all across. Again, it's not just inflation numbers, but it's always very interesting because the whole market kind of gravitates to this one thing and then generates this whole big, you know, narrative about, you know, what this means. And this is a whole new thing. So it's just quite humorous. But again, we saw this action yesterday. We talked about yesterday morning that a very hot read in the CPI, which was kind of expected due to the recent pop in ISM services and index and the prices paid index. That was a lot of front running for tariffs. So we had been watching that ISM prices paid and talked about that could feed into the inflation print, which it did yesterday. But we'll get into some of those data points this morning. But nothing's really changed from the long-term trajectory of where inflation goes, because ultimately that's driven by economic growth and wages, and both of those are clearly declining at this point, particularly after the last reads. So outside of that, though, like I said, we'll get into a whole lot more of that detail here in just a minute with Michael Lee. Let's go through all of that. But also, you know, on the economic front, we are starting to see some of the impacts from other things that are occurring within the economy. We're starting to see those kind of cracks in that surface. It was interesting in the last employment report. I've had some time to now kind of go through. I was traveling when that employment report came out, so I didn't have time to really dig into a lot of that. It was very interesting that a big chunk of all those numbers were just simply seasonal adjustments. You know, it's whether you look at these big gaps that we had, for instance, in full-time employment versus temporary employment, big gaps in that. And then all of a sudden in 1 month, that completely reversed. And so that was just simply a mathematical adjustment. It's like, okay, we need to make this, you know, the BLS is looking at the data and clearly they go, well, there's a gap between the household employment and the official report as an example. So we'll just put in a number that actually just brings those two back together. So problem solved, right? So that whole discrepancy over the last 2 years under the Biden administration has now magically disappeared with just one number. Did we actually put that many people back to work? No, it's just simply mathematical adjustment. So when you take a look at the data, you've got to strip a lot of that out. Clearly signs that the employment and the labor market is weakening across various sectors. And that really kind of gets into the whole job opening and labor turnover survey, part-time versus full-time employment relative to the population, all clearly showing signs of weakness. And that's going to feed into the economy as we get later into the year. Now, why is that important? Is because that feeds into earnings. And earnings are still extremely elevated here, at least estimates. But we are starting to see a rather sharp reduction in those earnings estimates across the board, particularly in the small cap space. What was expected to be this year was this was going to be the year of small caps. Small caps are now underperforming the S&P 500 index by almost 10 basis points, and that's 10%. Sorry, not 10 basis points, 10%. A very big gap. So we're kind of back to this whole thing that we saw last year where small caps underperformed, large caps really kind of led the show. That's really pretty much been the case already this year. And so we'll see that. Okay, here's what you need to know before the bell this morning. Very interesting day yesterday in terms of the markets because we talked about yesterday morning that it was very possible that if we had a really hot CPI print, we would come down and we would break kind of those support levels and open down, 1.5%, which is exactly what happened. Hot print came in, market opened sharply lower, and immediately buyers stepped into the markets and began pushing prices back up. And not only did we close above the 50 and the 20-day moving average, holding all of that support, we continue to hold this kind of consolidation and this pattern that we've seen. We've got lower highs, and kind of this running bottom of higher lows, and that's compressing the price here. And again, we said yesterday potentially we could break out of that. We didn't. We stayed right within it, and it was very interesting because immediately, even though the market finished slightly negative yesterday, it was down like 29 basis points. It was immediately after that inflation number, and again, we'll talk about this, why that occurred yesterday. But once you looked at that inflation print yesterday, it wasn't nearly what everybody was kind of suggesting at the headlines. And so we'll get into some of that data this morning, what caused it. But this is what the market looked right through yesterday and immediately saw that and then began to run it back up. And again, so this whole kind of consolidation range in the market continues to hold in place. We haven't triggered that sell signal yet. It's very, very close, but it's sitting right on it right now. And markets are not overbought. Again, so we're kind of just stuck here. But again, this whole very interesting pattern that we've been building in the markets, this market's just like in a wait and see mode almost. And, like kind of what's going to happen next. Is Trump going to put more tariffs on? That's one of the headlines today is reciprocal tariffs. Trump put on tariffs on aluminum and steel on Monday of this week. Markets really kind of just shrugged that off, didn't really care too much about that. And now we're talking about reciprocal tariffs on countries that have tariffs on our goods. So, so again, while we're talking about tariffs and everybody's like, oh my gosh, he's going to spark a trade war. Countries have already been tariffing us for a long time on our products, and what he's now doing is saying, hey, look, if you're going to tariff us, that's great. We're going to tariff you back. So these are the reciprocal tariffs that he's talking about. That could launch as early as today, tomorrow, this weekend, early next week. But he's working on that process. So again, this is kind of ramping up that risk of a potential kind of tit for tat in tariffs globally. But what a lot of people don't understand is that we're already being tariffed by other countries, which is impacting our exports as we export goods to those countries. And again, as I said before, 41% of corporate revenues come from those exports. So again, this is not a minuscule thing that is going on, and that's certainly going to have some impacts on economics. Not in a good way. It's also going to impact earnings because, again, as those tariffs do get put into place both ways, that raises the prices of the goods that companies buy. If they can't pass that on to consumers, that's where your problem comes in for earnings and corporate profits. So those are things that we're watching very closely. And by the way, I've got a very kind of a detailed article coming out tomorrow talking all about tariffs, impacts on markets, and all that's going on. So again, just kind of keep watch that. But bottom line takeaway here is markets are just fine. Nothing to do here. Again, if you've been a little bit worried through this, it has been volatile. If you've been a little bit worried, just reduce and rebalance some risk in your portfolio. But again, we're kind of watching the support levels. Until we break that, the markets are in good shape. All right, we'll come back. That's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Leibowitz. We'll talk all about the inflation number of the Fed, what all this means, or does it mean anything at all. We'll talk about that right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WE GP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome to the show this morning. So I need to set the table here real quick for Mike, and he's running about a 30-second lag on what he's seeing on his side. So he's going to have to play catch up with me here in a second. But I'm going to show you two charts real quick to set the stage on the inflation number yesterday, because, again, what everybody heard about was the headline. Lots of kind of panic and everything else out in the marketplace. But the market saw through that number very quickly and began to rally back fairly sharply. Even bonds, which opened down pretty quickly, rallied back, through most of the day because the markets kind of looked through that inflation number. This table we produce on a regular basis, I put this out on Twitter yesterday. But what this shows you is the 5-month change in inflation over time by the item and the weight that is in the CPI index. And the biggest drivers of inflation are housing, transportation, which includes energy prices, and food and beverage, which is 14%. And so you can see that as at the very right-hand side is the latest number. So food and beverages were up about 6.83%. That was up from 6.74% last month. That was the big jump in inflation, right? That was eggs. That's what's been going on with the avian flu. That's a temporary impact, but we're kind of seeing that work through. That's also an impact that comes from front-running tariffs, when there was a lot of talk about tariff increases, et cetera. Just after the election, we started seeing companies kind of front-run purchases on goods and services and things like that they can stock up on and hold, trying to get ahead of that tariff increase or that expected tariff increase. So that's part of that. Housing has been on a real steady decline. That's 44% of your index. It was back in October, it was a 12.58% increase. It's down to 11.63, which was down from 12.38% last month. So again, housing, the biggest component, declined. Apparel was down sharply. Transportation was up because of energy prices. Energy prices run about a 3-month lag. We had that big oil price spike really kind of going back about 2 months ago. So that's still kind of feeding through right now. So that's where we saw the oil prices come from. Also has an impact from tariffs as well, front loading purchases, et cetera, ahead of those tariff activities. But once again, medical care was down 13.67%, down from 14.61%. So deflation there. Saw deflation, education, communities, and goods and services. Now, energy was up from negative 1.86 to 1.24. That's that energy spike that we saw feed into transportation. So energy is part of transportation. It's excluded from the overall composite, but it's because it's inside of energy. I just broke it out so you could see that was the real driver. That was almost a 3% bump over the last month just in energy prices. So again, But again, this is why this is important, because one more chart here, Brent. So this is so, you know, when you take a look at headline, you take a look at core. Yeah, those ticked up a little bit, and you know, but still clearly within, you know, kind of this negative trend. The red line is in this chart is CPI less housing and healthcare, because those are your two biggest drivers. So if you and most of those are fixed prices for most people. Your mortgage rate doesn't change, your rent doesn't change, or you once you sign up for healthcare, that payment's the same every month. That doesn't fluctuate from one month to the other. So if you strip those two out, what you see is exactly what you would expect, is that the inflation bump yesterday all came in things outside of those two big variables, because that was the stuff most impacted by short-term impacts in the economy from avian flu, from tariffs, those type of things. So these are, but still, even within that, the trends of all this data is still to the downside. And again, that's likely going to continue to be the case. So let's, having set the stage here for that, let's get over to Michael Leibowitz this morning, get his take on all this with inflation. So Mike, what was your take from yesterday's numbers, and what do you think here? And I'm sure, you know, also we'll talk a little about what Powell was talking about on Capitol Hill yesterday as well.
Yeah, absolutely. The other thing worth mentioning is that CPI in January tends to run hot. We've seen that it tends to run hot. This has been going on for years, but it's been extra hot for the last few years. So there's anomalies that pop up in January, obviously, that the seasonal adjustments that the BLS makes can't properly do. You know, we saw it, you know, for instance, within transportation is also the effect of auto insurance, which popped 18%. Is that, first of all, is it real? Yeah, I mean, some of it, most of it, but we also had all those fires in California. How much of that was due to rates being raised because of lost cars? Right. Or the hurricanes that we had, you know, back in, what was that, September, October, that some of that's working its way through. And again, you know, car insurance is a lagging CPI factor, because car prices went up a long time ago, and it takes a while for insurance to catch up to that. Right. So
and also too, like all insurance, it resets at the beginning of the year for new rates. I mean, your insurance doesn't go up and down every month. Your insurance payment's the same every month until your contract resets.
Until it's done. Yep. Right. And again, Lance, you pointed it out. Almost half the number, 45% of the number is shelter. Every indicator of shelter, of what the BLS uses to create their CPI shelter, is basically zero. Some are negative, some are slightly positive. The number yesterday, which was better, was 0.4% for the month. That's 4.8% inflation for 44% of the number. If you bring that down to zero, or bring it down to even +2, that, you know, again, like you showed in the graph, CPI excluding shelter is a smidge, and barely a smidge, above where it was running for the few years before the pandemic. So again, I mean, it seems like this lag is longer, taking much longer than it has in the past, but it's a considerable part. It's a huge part of the number. And any one month, you know, that number could have come in at 0.2, and the market would have been equally shocked. You know, bonds would have rallied, stocks would have rallied. Yep. You know, the Fed would be more comfortable. They wouldn't be talking about not cutting rates. So these little gyrations in numbers, of which they're using surveys and estimates and all kinds of odd calculations to really calculate the impossible, becomes troubling from a market perspective when you're jumping up and down on numbers that we know are not correct and numbers that will be revised. Right. And it works both ways. You know, sometimes the numbers work in the market's favor, sometimes they don't. You know, we saw unemployment all of a sudden there were 600 something thousand less jobs from revisions. But all those employment reports that were stronger than expected, had their effect on the markets. So it's important not to look at any one data point in isolation. Look at the trends, look at the underlying components. Does it make sense? If we see this continue through February and March and April and May, it becomes a lot more concerning. But one or two data points, especially in a month that's known to have a lot of seasonal issues, should not be overly concerning. And I think the market at the end of the day reacted correctly, right? It was down slightly. Bonds had, come back a decent amount, and this morning they're making more headway. Again, one data point should not get you to sell all your stocks or buy a whole bunch of stocks, take on risk, reduce risk. Yep. You have to just kind of pause, really understand what's in it, and try to understand how that may change in the coming months.
Right. Well, again, there's so many, factors too that impacted this number. You had, again, when we talk about ISM prices paid, you had a big spike in ISM prices paid in November and December. And that was because everybody was front running. They were concerned about tariffs, and so they front ran that. Then you had the avian flu situation, which have increased the price of eggs. That's feeding into, kind of the data as well. And so these are all short-term anomalous effects. Now, later this year, we're going to have some base effects that come up. And again, so when we take a look at CPI, just so you remember this, that is just a year-over-year comparison. We take what the CPI number is in February as an example, and then we'll compare that to February of last year and what was that change. And we go, okay, so inflation was up, 0.4 year-over-year basis, right? It's 3.2% or whatever it is. Well, later this year, we're going to have less favorable because inflation was falling last year and sharply because of, when we were coming down, the post-pandemic, we hit 9%, we were coming down. We're now getting to that phase where the year-over-year comparisons are going to become less favorable. We're getting into a period where inflation is kind of stabilized. We're not going to, that base effect is going to be a little less supportive of bringing inflation down. So later this year, we're going to, and potentially, as we get into, kind of September, October-ish, November-ish, around that area, you're going to see more stable inflation. It's not going to be dropping as sharply as it was, back in 23 and really in early 24. So we're kind of getting that phase where, we're getting back to normalcy. I mean, we're at basically 3% inflation. There's about 1% to go to get to the Fed's target rate. And the Fed's target rate, by the way, is not 2%. It's actually 2.4. So it's going to take time for inflation to get there. So yes, inflation is going to be sticky as it slowly declines back towards that 2.4% target that the Fed's actually trying to get to. And it's just, like I said, it's just going to get there. But again, this is great for headlines. But again, to Mike's point, kind of strip out this volatility, pay attention to kind of what's driving markets long term. And again, ultimately, at the end of the day, when it comes to the financial markets, it's about earnings and earnings growth. And that's the big thing. We'll come back. We'll talk a little bit about what Jerome Powell said also yesterday. He made an interesting comment about mortgage rates, and we'll talk with Mike about that in just a second. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the health care fair insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife likes to open up the house. She had this idea that said, hey, can we just put a little black fence around the porch? And you have to submit all this to the HOA.
The Real Investment Show podcast.
They sent back this letter. The fence is disinharmonious with the neighborhood. Not disharmonious, not inharmonious. We had to get it all in there. It was so inharmonious that we had to do disinharmonious.
That's our word for the day.
Yes, disinharmonious.
Same show, your schedule.
So what are you going to do?
We're doing put bushes up.
And then put the fence up.
And then put the fence up. I could just say it was there to help the shrubs. Good idea.
Topiary support.
Topiary support. I like it. I like this a lot, actually.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
By the way, as we're talking about tomorrow being Valentine's Day, it also starts the last half of the month, which February's last half of the month tends to be fairly weak. So just seasonal tendencies that tend to come into play. So we'll see kind of what happens with the markets. But markets have been holding in their really good support here as of late, not really going much of anywhere, just kind of, trending back and forth, but not really making any gains, but not really losing any ground either. So it's been kind of a tough market to trade over the last month or so just because of the volatility. But again, we lose a little bit of that support now heading into the last half of the month. But on the good news is that buybacks are in full force. So that window for corporate share buybacks is certainly out there. Mike made an interesting note in today's daily market commentary. If you haven't read it when it comes out this morning at 7:30, if you haven't subscribed to our daily market commentary, we send it out every morning right at 7:30. So you get that by email. But he made a really interesting note that Meta has been on a historic surge. I think it's like 18 or 19 days of positive returns in Meta. It's quite abnormal. But that stock just had a huge run over the course of the last couple of weeks. It's been pretty amazing. So just for the break, talking a little bit about inflation, and of course, Jerome Powell was up on Capitol Hill yesterday. Actually, the last 2 days, just kind of talking about monetary policy and that in front of Congress. It's the annual testimony. And he did make this one interesting comment, Mike. He said that mortgage rates, there was a question about housing affordability, right? The housing is just not affordable right now. And he says, well, mortgage rates are really controlled or outside of the Fed's control. The Fed controls the short end of the curve, which is true. He says we don't really have much to do with the long end of the curve. That's really kind of driven by long-dated Treasury rates, and so 10-year Treasury rates 4.5%ish. So your 30-year mortgages, 30-year bonds are around 4.7. So your mortgages are going to be 6-ish when you put on the premium for a mortgage. which is about where mortgage rates are, give or take. So I thought it was interesting because he said that, but at the same time, they have about $2.4 trillion worth of mortgage-backed securities on their balance sheet that they could certainly impact or have an impact on longer duration mortgage rates if they started to go back to QE and started expanding their holdings of mortgage-backed securities. I just thought it was an interesting take that he made. Your thoughts?
Yeah, I mean, I think the truth kind of lies somewhere in between. The Fed doesn't set mortgage rates. They don't set auto loan rates or corporate borrowing rates. They set the Fed funds rate, which is just where banks borrow from each other overnight. And to be honest, they don't even set that rate. They guide it by putting money into the system or taking it out. So they steer it. And their steering mechanism is extremely strong, effective with the Fed funds rate. But as you move out the maturity curve, you get to longer and longer maturities, their impact becomes less so. So, the Fed doesn't directly control mortgage rates, certainly, but they do have a decent impact, both in just what they're doing with monetary policy and how it affects the economy, how it affects inflation. But Lance, to your point, they own, what'd you say, 2-point-something trillion?
Yeah, I don't have the exact
securities?
number. It's over 2 trillion. I think it's like 2.3, 2.4. It's up there.
Right. So, when they do QE or QT regarding mortgages, they are having a more direct impact on mortgage rates. But no, the Fed can't get more in today's environment. The Fed just can't say mortgage rates are going to be 3% and get them there. They can try to steer the long end of the curve. And this is the Fed's big problem, right? The Fed cut rates by 100 basis points, and the bond market's reaction was to boost rates by 100 basis points. So, like I like to say, the Fed kind of dovishly is hawkish. Whether they wanted this to happen or not, and we could certainly debate that, they have a more hawkish policy when they started cutting rates, as crazy as that sounds.
Right. Well, and again,
that's it.
Yeah, and I was just saying, and again, the one thing that the Fed's not doing is they're still doing QT. They're still liquidating their, reducing the size of their balance sheet, which is certainly pressure on bond yields, right? Because as they're selling, if you're selling bonds, that's going to increase the yield on interest rates. So they have a tool at their disposal to bring rates down, but they would have to reverse back into balance sheet expansion, which they don't want to do yet because there's no real demand for it at the moment. Once we get back into some type of, economic downturn, or if interest rates really start to move substantially higher, that it begins to impair financial stability within the banks, they're going to revert back to QE. That's going to be their tool, but there's no reason to do it right now. Everything's fine. Markets are doing great. The credit markets are doing fine. Credit spreads are extremely low. There's no financial risk really in the markets anywhere at this point. So for the Fed, getting their balance sheet down, kind of reloading that ammo that they've got for the next event whenever it occurs, is certainly kind of the right thing to be doing. But again, they could be impacting rates to some degree if they went back to doing QE today. But again, there's just no reason to do that.
Well, and to your point, yesterday he was asked a question about that, and he said we will not do QE until the Fed funds rate gets back to zero.
Right.
Whether I believe him or not is a different story. But
I think they'll happen simultaneously.
And then the question is how quickly till rates get back to zero. We saw in COVID they got them to zero in a hurry.
Yeah.
So. I think that's important. The other really interesting thing that he said yesterday, someone had asked him about CPI and it was running hot. And he said, we target PCE inflation, which is a better measure. And we'll know what that is later tomorrow. He said this yesterday, so tomorrow is later today. And what he was referring to was after the PPI report, which comes out this morning. Mm-hmm. So PCE is, we've known that's the Fed's preferred measure. Core PCE is, I think, what the Fed relies on the most. So it's PCE excluding food and energy.
Right. And just real quick, Mike, just to clarify, we're throwing around a lot of acronyms on the show, and we apologize for that. CPI is the consumer price index. That's the index that measures consumer prices. Today is the producer price index. That's the index that measures changes to producer prices. So what are producers paying for products, goods, or services they use in their business to make a product to sell to consumers? So PPI will ultimately translate to CPI. And the one thing really important ingredient today that we'll find out is we will find out in today's producer price report. We can look at the spread between PPI and CPI, the changes there, to see how much inflation are they able to pass on to consumers. So if we see today that there's a positive spread between the changes in PPI to CPI, we'll know that that's okay. Producers are passing on all their inflation to consumers and consumers are buying it. Or we'll find out today that they're not able to, and that's going to start to impair earnings because they've got to retain that inflation. Now, PCE, that is the personal consumption's expenditure index for inflation. So again, 70% of GDP is driven by the personal consumption expenditures index. And what the Fed looks at is the changes in prices in that consumption index. And that's why that's their preferred measure, because it's a very broad measure of inflation. It's better than CPI and PPI, although those do have inputs into the PCE report. So go ahead, Mike.
Right. So essentially what he's saying is that PCE is a mix of CPI and PPI, that when you have both components, you can back into what PCE is going to be, because PCE won't be released until the end of the month, so probably 2 more weeks from now.
Right.
PPI, just for reference, PPI comes out today. Core PPI, again, that's kind of the one that's going to feed core PCE, is expected to be up 0.1%. It was 0% last month. So the way he kind of offered that is, we don't really care too much about CPI. It's really PCE that gets us to take action. The way he said it leads us to believe, and again, we could be dead wrong, and who knows what he really means, that PPI will be tamed today, which will help offset some of that CPI surprise in the markets yesterday. But again, we'll see. And ultimately, we'll see in 2 weeks what PCE prices come out at. And, I'm not sure it's going to make a difference. I mean, the Fed really seems like they're handcuffed. Most of the Fed members that have spoken don't want to cut anymore. Very, very few are even thinking about raising rates. But just the fact that anyone is even talking about raising rates tells you that the Fed is really stuck where they're at. And the Fed funds market isn't even pricing a full rate cut till the end of the year.
Right. And
so the market, and this is a good thing, the market and the Fed are on the same page.
Right. Real quick, too, just in the chat right now, a comment was made that the Treasury issues the 10-year bonds, which controls rates. That's not correct. Yes, the Treasury does issue the Treasury bonds. They issue all the bonds, right? Because how do we create money? We create money by lending it into existence. We had that conversation last week with Michael's article. That's done by the Treasury issuing debt. The primary dealers are the ones that are setting the rates. That is the supply and demand. So as supply comes to market, if there's not enough demand for all that, for the Treasury debt that's coming in, then the buyers say, you're going to have to give me a little bit better yield if you want me to buy it. They have to buy it. There's no doubt that all the bonds will get bought because they are required to buy all the debt. But the buyers are the ones that set the rate for which they will buy that debt at. It's always supply and demand in the markets. It's always driven by market dynamics. So the Treasury does not control the rates. The market sets the rates. All right, be right back. Pick up with Michael Leibowitz. Got a couple other little topics here to finish up the show with. Don't go away. More of the Real Investment Show coming right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Mike Lee was with me here as well. Real quick, Mike wanted to jump over to your article that you published yesterday on the website because it's kind of interesting talking about value versus growth and really kind of, how we ascribe, value and growth measures, right? So we say, NVIDIA, it's a growth stock, but is it really? And so if you haven't read the article yet, it's actually a very, very good piece. It's on the website now, realinvestmentadvice.com. But it is kind of interesting when you start looking at stocks that you traditionally think are a value stock, maybe they aren't really value stocks at all.
Yeah, so actually, I'm going to double back real quick to inflation, and then we'll get to value and growth.
You just couldn't let it go, could you?
In our commentary, I believe it was yesterday morning, we talked about Truflation. Truflation is a private measure of inflation. I believe it's something like 20 million, almost real-time, more or less real-time prices to gauge what the inflation rate is. And they have shown that they are an incredibly well correlated to CPI, which is a good thing. But they tend to lead CPI by 45 days. And that's because, again, there's a real time. They're not, using these surveys. They report it daily instead of once a month. So it helps explain some of that gap. And what we showed was that, first of all, the correlation is extremely strong. But what's happened to Truflation over the last 2 months is that it has gone from about 2.8% to about 2.10% over the last month and a half.
Wait, say that again. What 2.8 to 2.10?
2.80 to 2.10.
Oh, okay.
So it's dropped about 70 basis points. And again, this has an incredibly high correlation with CPI. So if the relationship holds up, sometime between the next 2 to 3, possibly the next report, but most likely the one after that and the one after that, should see a decent decline in inflation, 0.5, 0.6, 0.7%. So check out the commentary. We show the graphs and we talk about it a little bit. Growth versus value. So what, and Lance and I are guilty too. We'll say the price to earnings of something is this, it's expensive, or the price to sales is that, it's cheap. And those are all incredibly valuable indicators. But what a lot of valuation techniques do not incorporate is growth. So who cares that a company has a PE of 5 or a P of 50? What we also want to know is what's their growth potential. If a company has a PE of 50 and say the market PE is 25, the market's essentially saying that their growth should be double that of the market. But what if their expected growth rate is quadruple that of the market? That's a value stock, even though it has what many people would consider a very expensive valuation. So, and we can look at this through what's called the PEG ratio, and we do use the PEG ratio all the time. It's just price to earnings divided by the growth rate, by the expected growth rate over the next 3 to 5 years. And what we did in the article was we downloaded the PEG ratio for all 500 or so S&P 500 stocks. We threw out about a dozen or so, either because they have negative earnings or their PE was just outlandish. And we graphed them all. And on the graph, we showed the PE ratio on one axis and the expected growth rate on the other. And we drew 2 lines through the graph. One is basically everything that has a PEG ratio equal to that of the S&P 500. So you can say what's rich or what's cheap to the market based on what, we use Zacks data, what Zacks thinks expected growth is. And then we drew one at a ratio of 1.0. And that's it's an old time rule of what's cheap versus expensive using the PEG ratio. And, first of all, not surprising, there's not many stocks that are cheap. I think there were 19%, I could be wrong, but about 19% had a PEG ratio less than 1, and maybe something like 29 or 30% less than the market. So, given that valuations are high, it's not surprising that the PEG ratios are high as well. And then we went through 6 companies, all different types of companies, to show that a growth company can also be a value company. And what many think is a value company, like I mentioned Ford has a PE of 10, their growth rate is horrendous. So even though they have a PE that's well below the market, their growth rate is also well below the market. So the point is, it's just kind of a reminder piece that growth is every bit of as important as these kind of backward-looking valuation techniques. And for some companies, it's more important than others. Like when a company is consistently growing at the same rate, you can look backwards, you can look forward. You're gonna come out at the same level. But when you're starting to look at companies like the Magnificent Seven, that some of them have magnificent potential growth rates, or small companies, startups, and all companies in between, take a look at their growth rates as well as everything else. And I think what you'll find is there is some value in growth, and there's not always value in value.
Well, that's right. I mean, and again, everybody, kind of looks at NVIDIA. I thought it was interesting. You got a PEG ratio in NVIDIA of 0.8, something like that.
Right. It's below 1. So
yeah.
NVIDIA, even though it has a huge PE, is a value stock, believe it or not. But, again, we can debate all day what the right expected growth rate is, and that's what makes the analysis difficult. And if you think this DeepSeek has changed the world and NVIDIA is out of favor, then it's not a value stock at all.
Right.
But but again, I can have pie in the sky expectations too, and say it's not only value, it's deep value. So
yeah.
We can deep value for DeepSeek.
Yeah. I think there's a little bit of in between ground there somewhere.
Right.
But hey, you know what though? We're going to find out shortly. They report earnings next week, I think, or week after.
Later February.
Yeah, February 26th. So a week after next, they'll report earnings, and we'll find out exactly kind of what their growth rate is looking to be. And because they've had plenty of time now to kind of factor in DeepSeek into their kind of their thinking. And so I'm sure they'll make some, the CEO will make some comment about DeepSeek and what that potentially means for their market. So we'll find out. So it's coming up.
And we were actually talking about tariffs, and you made a great point that because of tariffs, how many prices were raised in advance of tariffs, and how much buying took place because of expected tariffs coming, and how that affected the CPI. Well, how will that affect NVIDIA sales? Will their sales be better than expected because some people are worried about potential tariffs on their chips and bought more than they needed or ordered more than they needed? We'll find out.
Yeah. So it's gonna be very interesting to kind of play across the board to see how this all works out. And again, NVIDIA, of course, will wrap up all the Mag 7 stocks. That's the one outlier, the Mag 7, that hasn't reported yet. So we kind of know we know we have a really good flavor for what earnings season now looks like, but they're the one outlier that's still sitting out there.
Right, and
go ahead.
I was going to say the interesting thing with the Mag 7 earnings, it seems like investors were much more focused on their outlooks than their earnings. A lot of them had good earnings and guidance that was not unbelievable, and they sold off. So NVIDIA, I think too, it's going to come down to their guidance and probably their reflections on the DeepSeek and what it means for their business and what they're seeing. So it'll be important on a lot of levels, and not just for NVIDIA, for probably some of the other chip makers as well. Yeah,
there's a couple of interesting articles out this morning too, just talking about inflation, which ultimately is going to be driven by economic activity. And that's in order to have economic activity, you've got to have employment. And an interesting headline this morning, the Wall Street Journal: Trump layoffs push federal workers into a tough job market. One thing we've talked about before is that a big chunk of the government the hiring that we've seen has been in government jobs, which are higher wage paying jobs anyway. And, that's been affecting wage growth. That's been affecting employment numbers. And so, again, we may start to see some of the impacts of what's happening in Washington. Another interesting headline: D.C. internet searches for criminal defense lawyer and RICO law erupt as Doji drains the swamp. Final tally for Biden era improper payments, $925 billion. So, we're talking about cutting the deficit. That $925 billion in improper payments, where did all that go? Some of that wound up back into the economy. So if those aren't going to be made anymore, there's impacts coming from what's happening in Washington that is going to have an impact on economic growth and i.e. ultimately inflation because of the supply-demand equation.
Yeah, and being here in D.C., it's going to be very interesting to see how it affects the local economy. How many more houses are going to be up for sale? How many restaurants are going to go out of business if a lot of these layoffs or retirements happen? Or just spending cuts is going to affect the D.C. area much more than most other regions in the country.
Yeah, so it's going to be interesting because the number, it's the people searching for criminal defense lawyer, that's a 300% jump in D.C.
I'm not one of them, Lance.
just saying. Yeah, well, we'll see. And, that's all coming at a time where, the number of houses getting taken off the market because they're not getting sold is rising pretty sharply. So, people are putting their house up for sale, can't sell it because of where rates are, and they're pulling the house back off, which is going to, kind of beg the question, and maybe we'll have this conversation, next time is, well, what happens when rates come down? There'll be this massive supply of people coming to market to sell their house because they can finally get it sold. What does that do to housing prices at that point? Could be the opposite of what you would expect. All right, wraps up the show for today with Michael Leibowitz, of course. Be sure and like and subscribe to the channel. Get by the website. Get our latest daily market commentary. I'll have that blog out tomorrow morning on tariffs under the Trump administration, term one. What happened to inflation, economic growth, and markets during that period of the trade war, and kind of using that as a basis to what to expect this time around. All on the website tomorrow, first thing in the morning, realinvestmentadvice.com.